Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, China has moved to support its exporters ahead of Donald Trump's anticipated tariff hikes. And its drive for self-sufficiency is accelerating. Is Beijing better prepared for another trade row with the US this time around? He's a billionaire investor. Scott Bessent is Trump's pick for US Treasury Secretary. But can he strike the right balance between embracing the president-elect's policies and maintaining market stability? And Chrome is the world's most popular web browser. It's also an important part of Google's business. But US regulators are demanding the company sell it in an attempt to end tech monopolies. In 2018, when Donald Trump launched trade restrictions on China, its economy was flying high. Today, though, the nation is struggling with a real estate downturn, a debt crisis, and deflation, all of which are dragging down its economic growth. This has made many Chinese companies shift to focus on sales abroad. But US President-elect Donald Trump has recently vowed to raise tariffs by an additional 10% on all Chinese imports as soon as he takes office. This time around, China looks to be prepared for another trade row. It's announced measures aimed at supporting its exporters ahead of the start of the second Trump administration. But are they enough? We'll discuss that with our guest shortly. But first, Kulsum Sharif reports.
China's President Xi Jinping on a diplomatic offensive. Since Donald Trump's re-election as US president, the Chinese leader has been shoring up support at global events. Trump's return to the White House has stirred fears that tensions between the world's two largest economies could worsen.
If we treat each other as opponents or enemies, engage in vicious competition and mutual harm, China-US relations will suffer setbacks or even regressions.
Xi's plea for a smooth transition have been met with more threats, with Trump announcing he intends to impose major tariffs on the United States' three largest trading partners. He's promised 25% tariffs on Canada and Mexico and an additional 10% on all Chinese imports when he takes office on January 20th. Shortly after Trump's social media posts, the Chinese embassy spokesperson tweeted to say there are no winners in trade wars. But Beijing has been bracing for Trump's return to the White House with his America First policy and threats during his campaign of tariffs as high as 60% on Chinese-made goods. In his previous term, Trump imposed tariffs of up to 25%, triggering a retaliation from Beijing.
The way they will sell their product in America is to build it in America. Very simple. Build it in America and only in America.
Beijing has unveiled new measures aimed at boosting the country's foreign trade. They include more financial support for firms, expanding agricultural exports, and imports of energy products.
The Ministry of Commerce will work with local authorities and relevant departments to closely monitor foreign trade operations, analyse changing conditions, ensure the implementation of foreign trade-related policies, and help foreign trade enterprises keep orders stable and expand markets, so as to provide strong support for sustained economic recovery and growth.
Trump's second term comes as China is struggling to kickstart its flagging economy. A $1 trillion plan is in place to help clear local government debt and fix an ongoing property market crisis. But economists expect Chinese exports to rise, with customers rushing to place orders ahead of Trump taking charge to avoid possible higher tariffs. Exports have already grown since July, putting China on track for a record trade surplus this year. Kulsum Sharif, Al Jazeera, for Counting the Cost.
Well, China's been the top exporter to the US for 2 decades, but Mexico overtook it in 2023. The value of Chinese imports to the US tumbled 20% to $427 billion last year. China's exports to the Group of Seven, or G7 countries, also dropped to under 30% last year. That's down from 48% in 2000. In 2023, China was the third largest partner for EU exports and its biggest importer. Bilateral trade reached nearly $775 billion last year. That's a drop of 14% compared to 2022. Trade between Russia and China has strengthened since 2022 after Russia's invasion of Ukraine. It hit a record $240 billion last year, but exports slumped to almost 16% this March from a year earlier, with growing US threats of war sanctions. However, China has built alternative sales networks. With the Association of Southeast Asian Nations, bilateral trade with ASEAN has seen an average annual increase of 11% from 2004 to 2023. Now, despite setbacks, China remains the top global exporter, with $3.4 trillion worth of goods, exceeding the US by nearly $1.4 trillion. The nation's exports surged more than 12% in October and are poised for further gains. Joining us now from Hong Kong is Gary Ng, who's senior economist at Natixis and a research fellow at the Central European Institute of Asian Studies. Gary, good to have you with us again. Can China somehow circumvent these tariffs that Trump has promised to slap on Chinese exports? Has it done enough to prepare?
Well, I do think it's not the first time that China faced a situation like this. Definitely, China is more prepared than what happened in 2018. So far, we have seen China trying to de-escalate the situation with the non-US market through cutting some of the export tax rebate. At the same time, there are also more demand-side policy that may be rolled out, at least to mitigate part of the impact, away from the US market. But still, it really depends on whether Trump will actually implement a 60% of tariff on China, because right now, if it is only 10%, it's possible to see some of these measures working. But if we're only talking about 60%, then the story will be quite different. So China is better prepared, but it's hard to fully detach from the US market immediately.
And if Trump does that, worst case scenario, would China retaliate and impose its own tariffs? Are we looking perhaps at a trade war here?
Well, under the scenario of the Trump 2.0 with more tariff, I think this is really something that is quite likely to happen, which basically means the mutual retaliation. But of course, what China may do also depends on what Trump will do as well, because if we are talking about somewhere like 10% or even 30% of tariff of all the goods basically shipped from China to the US, then it's possible to see China doing the same thing. At the same time, beyond the export side, it's also possible to see China restricting some of the core raw materials, or basically certain products that China has a very, very big global market share, to in a way trying to punish or negotiate with the US. This is also something quite possible, even though China may not be able to produce, let's say, the most advanced chips to that sense. So yes, I think we're really heading towards a more intense geopolitical tensions for possibly 1 or another 2 years.
All right, Gary, let's just for a moment assume that there would be a trade war. What would that feel like for the likes of you and I and people watching all over the world? I mean, we've got quite used to seeing goods on our shop shelves from everywhere nowadays. If there were a trade war, would that change?
Well, indeed, I would say if the tariff really gets so high towards 60% or even 30%, right, it will largely hurt the profit margin of the either the Chinese or the US firms exporting towards each other. So basically, it is really a backtracking with what we have seen in the past decade in the globalization, of which countries try to do or optimize the production cost at the lowest way, and therefore consumers are able to buy goods at the cheapest price. So I think this is really something that is dialing back a little bit. However, it also depends on whether there are alternatives at its sense, because the US may be able to do that, because part of this import can actually be outsourced maybe to ASEAN, India, or other countries. But if we're really talking about the whole world decoupling from China, then how do you suddenly find maybe maybe the 80% of the China's production elsewhere, whether other countries can actually develop that quickly, I think that is a very, very good question to ask. So in a way, I do think that inflation pressure will be much higher than people expected earlier this year.
Gary, of course, China's economy is not in the place that it was at the beginning of the last Trump administration. It's suffering low consumer demand at the moment, the moribund housing market that we've heard a lot about on this program. How would these tariffs, if Trump introduces them on Chinese goods, impact upon an already sluggish Chinese economy?
Well, I think it really depends on where the tariff actually target beyond the exact percentage. And so far, we have seen these stronger measures probably targeted to made in China goods, which basically means that it's the direct trade between US and China. But at the same time, Trump has also imposed quite a large tariff on some of the partners as well, like Canada and Mexico. So there's actually a worry that this target towards made in China can be expanded to made by China. So I think this is really something that may cause some of the Chinese firms a bit off guard, even though they are more prepared than before back in 2018, because a lot of them has actually moved their production elsewhere, trying to export to the US through the third market. So this is something that we have seen, which is quite different from a few years ago. But still, I doubt whether it can actually fully offset this impact. So which basically means that together with the domestic weaker demand, it's possible to see Chinese growth taking probably still a reasonably big shock compared to before. It's possible to see like a GDP growth decline by 0.5 or to 1 percentage point, depending on the ultimate tariff that are being imposed. So yes, the situation remains quite challenging. So therefore, I do think that China will continue to explore other markets, but this is not an easy job.
Gary, stay with us. I want to ask you about our next item here. Huawei has launched its first smartphone that can run on the Chinese company's self-developed operating system. The tech giant aims to establish Harmony OS Next as a major rival to Apple's iOS and Google's Android, which dominate global markets. The company's early versions of the devices were built using open-sourced Android code. Huawei didn't mention what chip its new Mate 70 phone was running on, but the launch is part of the Chinese giant's push toward technological independence in the wake of US sanctions. What do you make of that, Gary? Is that a sensible move from Huawei? I mean, could we see its operating system become a serious rival to iOS and Android?
Well, I do think it is quite a significant milestone in the way that China actually tried to move away from the traditional Western technology and develop its ecosystem. So this is really something remarkable that can have basically become a game changer in the China's tech sector. And especially if you think of some of the areas that China is lagging behind global peers, it's really about semiconductors, of which is trying to make more, invest more. And the other way is really on the software side, of which this is something that I would consider as a breakthrough. But again, I think there's still many hurdles. The key point is this software is only being able to use on Huawei's device because it's a closed system. So whether Huawei can actually sell more phones, actually to bring in more consumers so that the pool can actually get higher, and eventually whether it can export to the rest of the world. I think that is also a very, very big question here, even though Huawei has tried to recruit or basically get more apps on the system, it's still not comparable to Android and Apple at this stage. So I think we still need to wait and see to see how it goes. But yes, I think this is probably also like a warning to the US in terms of the sanctions may not actually be fully enough. It actually fuel the China's ecosystem because they are being forced to develop it.
Gary, it's really good to talk to you on Counting the Cost again. Many thanks indeed for being with us. He's one of Donald Trump's biggest financial backers. The president-elect has nominated Scott Bessent to lead the US Treasury Department, a top financial job and one of the most influential roles in government. Now, if confirmed by the Senate, the hedge fund manager is seen as a safe pair of hands who could push Trump to soften some of his economic policies. Among his tasks, overseeing Trump's pledges, including sweeping tax cuts and tariff hikes, public debt, foreign trade and US sanctions. But many economists say that Trump's policies could reignite inflation and slow economic growth. Now, that could pose challenges for Bessent in maintaining the stability of the world's largest economy, its bond market, and, of course, the dollar. Sarah Gill reports.
A billionaire hedge fund manager is Donald Trump's final pick to lead the US Treasury Department. Scott Bessent's nomination ended weeks of speculation, drama, and infighting for the powerful cabinet position. Wall Street reacted positively to the president-elect's choice.
The bond market's responding well to the Treasury Secretary nomination of Scott Bessent. And kind of with that nomination, you see the 10-year kind of rallying about 12 basis points or so back to kind of pre-election levels. That has really important style leadership ramifications for the equity market. And what you're seeing in response to that is some of the most interest rate sensitive parts of the market up sharply.
62-year-old Bessent, a Wall Street financer, was an early backer of Trump's 2024 bid and became one of his closest economic advisors. As Treasury Secretary, Bessent is expected to fulfill the president-elect's promise for tax cuts and sweeping tariffs on imports.
And when I'm back in that beautiful White House, we will pass larger tax cuts for workers, and we have a special tax that here is going to do, I think, quite well. It's called no tax on tips. No tax on tips. No tax on tips.
Bessent's nomination almost completes Trump's cabinet picks ahead of his return to the presidency in January. If confirmed by the Senate, Bessent would be the person in charge of pursuing Trump's economic agenda, heading from Wall Street to Washington. Sarah Gill, Al Jazeera, counting the cost.
Joining us now from Washington, D.C. is Ottaviano Canuto, former Vice President of the World Bank and Senior Fellow at the Policy Center for the New South. Good to have you with us, sir. Is a veteran of Wall Street necessarily the best candidate for U.S. Treasury Secretary?
I believe so in the following sense. Look, the nomination of Mr. Bessent as Treasury Secretary has eased investor fears about President-elect Donald Trump's trade tariff plans. The choice of Bessent, I saw him last month describing sweeping tariffs as maximalist positions, has been taken by investors as a sign that the president-elect's policies may be moderated. See, along the campaign, Mr. Trump alluded to two possible paths. One of them was simply the open trade war by lifting tariffs and so on. And the other one was when he made reference to his tariff plans as negotiating tactics. So in this sense, the nomination of Mr. Bessent, as compared to Mr. Lighthouse, for instance, points toward the direction of a use, most likely, of tariffs as a negotiation. See, of course, the fears will remain because, after all, the Treasury Secretary is not necessarily the main person who will design the finer details of the strategy of trade tariff implementation. But the fact that Mr. Trump appointed him, despite the fact that exactly over the months he has referred to the trade tariffs as negotiating tactics and so on, is a good omen in that regard.
Many thanks indeed for joining us on Counting the Cost.
A pleasure.
Rich countries have pledged to raise their funding to help poorer countries fight climate change to a record $300 billion a year. But many developing nations dismissed the agreement as insufficient. A larger target of more than $1 trillion annually was also part of the deal, but most of that will come from private sources. The deal was reached at the COP29 climate summit in Azerbaijan's capital Baku last week. Two-thirds of the world's web browsing is done on Google's Chrome. The web browser is very popular with more than 3 billion active users. Owning it is important to the tech giants and business. Now, Google relies on Chrome to direct web surfers to its flagship AI product Gemini, among other crucial uses. But US regulators believe that the app has too much power and they want it sold. They're taking legal action to end Google's market dominance and to encourage competition. Well, last week, the US Department of Justice also asked Judge Amit Mehta to push Google to share data and search results with rival browsers. In August, Judge Mehta ruled that Alphabet had a monopoly over online search and related ads. Google was accused of breaking the law by paying $41 billion to ensure that it was the default search engine on smartphones and browsers back then. American regulators have cracked down on tech giants' dominance of the internet and search in recent years. But how could a sale happen? Well, like many nations, the United States has antitrust laws which allow the government to break up monopolies and large corporations through the courts. If Judge Mehta rules in favour of all the Department of Justice's recommendations, Google would be forced to sell Chrome and would be banned from launching a new browser for 5 years. The company would also be barred from paying billions of dollars to companies to make Chrome the default search engine on their devices. Google has the option to appeal, of course, any rulings, potentially prolonging the legal battle. Joining us from London is Shahzad Ansari, a professor of strategy and innovation at Judge Business School at the University of Cambridge. Good to have you with us, Professor. This case has been described as the biggest tech antitrust case since the US government's showdown with Microsoft at the turn of the century, and a win for the American people. Shahzad, what do you make of it?
I think it's a pivotal moment. It's a very important moment in the digital landscape. It's a huge step. I agree with that. I think there's been a general narrative in trying to reduce big tech dominance, but I think they're addressing the wrong issue. That's my personal opinion.
So what is the issue that they should have been addressing?
The issue is that two things, right? So one is that, yes, it does have 2/3 of the share of the market as compared to Safari, as compared to Microsoft Edge. But the real dominance of Google lies in its search capabilities and the data it collects from users. Of course, Chrome helps in getting personalized data, but the real dominance of Google is search with a 90% share. So that it can still continue, and you've seen Microsoft Bing make some inroads, but it's still under 10%. So I feel divesting Chrome is not going to really address the key problem, which is Google's dominance in search. And I'll have one more point why I think this is still not the best use of taxpayers' dollars, even though I'm all against big tech not mis-exploiting consumers, including my own data. But I have a reason, and I'll give you one or two other reasons why I think this may not be the most appropriate approach.
Please do.
Well, first thing, as I said, was that the main issue is not Chrome. The main issue or the main dominance of Google is search. So as I said, with a 90% of share, most people use Google search. And because more people use Google search, it creates a self-reinforcing cycle. And I think it's very difficult for any other company to break this dominance, because the more people use Google, the better results you get. And there's no reason for people to shift to an alternative which gives inferior results. So this network effects, as we call them, on this self-reinforcing cycle maintains Google dominance. So that's point number one. But the point number two that I have, which is more important, or why I think this may not be the most appropriate approach, is that regulation seems to be playing catch up rather than being proactive. And I'm all for regulation. I'm pro-regulation. I'm pro-governance. But what I'm not so excited about is that this is like fighting yesterday's problem. So for me, the problem is that Google search, Google Chrome, this is already being disrupted by Gen AI, things like OpenAI, ChatGPT, Cloud, Gemini's own cloud, Anthropic's, et cetera. So this Gen AI is changing the search game. So what's happening is, with all new kinds of browsers, new kinds of search engines coming up, which integrate AI, which allow more personalized results, more customized results, they're already disrupting the market. Even Google search could be disrupted by that. So my main point is, you should be focusing on something that could become a monopoly, such as OpenAI and GenAI, rather than addressing yesterday's problems.
OK, let's get back to yesterday's problem. If Google is forced to sell Chrome, what would that do to its business model? I think we've perhaps addressed that in your previous answers, but who might buy it?
I mean, of course, I mean, it could be small and medium-sized enterprises. I mean, Internet has, of course, Microsoft has its own edge. We have DuckDuckGo, which is a private, respects your privacy for certain things. It works well. So there might be a small, medium enterprise that buys it, but Google could pivot to things like subscription models. For example, it could do a premium service where it charges you without the plethora of ads. And on top of that, this is my personal view, I think Google has done some fantastic things, and on search, it's an absolute leader, 90%. But Chrome itself is not a great product. I mean, I personally keep switching. Sometimes I use Edge, sometimes I use Chrome, sometimes I use Firefox, sometimes I use DuckDuckGo. And it's not even a very conscious decision at times. And I personally think that with this plethora of ads, Chrome is not even the most superior product out there. Even though it has a 2/3 or 60-70% market share, it is definitely not the most superior product out there. So I just don't feel if divesting Chrome is significantly affecting Google, even though Chrome lets Google get personalized data on users, that of course then that feeds it to its search engine, that then allows it to be the leader in advertising.
This has been absolutely fascinating. It's really good to talk to you, Professor. Many thanks indeed, Shahzad.
Thank you.
And that is our show for this week. If you'd like to comment on anything that you've seen, I'm at @afinnegan on X. Try to remember to use the hashtag AJCTC, or you could drop us a line. Countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire editions for you to catch up on. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan from the whole team here in Doha. Thanks for being with us. The news on Al Jazeera is next.